So that was kind of the qualitative view of the world. Now let's get to the quantitative view, technical kind of view of the world, to see if I can express an opinion as to which way it's going to go. Now I've referenced this chart a couple of years ago, and it's the one thing in terms of macro stuff that has helped point the way in what the Australian dollar can do. And let me try and explain this. So first of all, on this chart, we're going back to 1991 to 2013 here, and on the left hand scale we've got the Aussie dollar. So this is the Aussie dollar versus the US dollar in blue. And so back here in 91 we were sitting at about 80 cents, couldn't get through 80 cents, and we dropped off down to 50 cents in 2000. And you remember during that period leading up to 2000s we had the dot-com boom in the US, and all the investment flows were flowing into the US. Well, here in Australia we had nothing in terms of high tech. It was a tiny little boomlet that happened here. We had nothing in terms of the major players. There was a couple of little companies that kind of made it big on the global scene, but effectively, we were a resources economy. There was no kind of high tech here, and a lot of the high tech was actually being kept back by our infrastructure, and a lot of stuff, for example, Telstra, which was the public telco provider, which was privatized, was kind of instrumental in many ways in stopping a lot of the development in terms of the internet infrastructure. But anyway, during that time we were out of favor, and that's why our Aussie dollar kind of fell down to 50 cents. And then since then, in 2000, we had these two commodity booms that propelled the Aussie dollar forward. And so the Aussie dollar has kind of made it up to a dollar parity with the US dollar in '08, just before the financial crisis, global financial crisis hit. And then when the financial crisis hit, we got whacked down to 60 cents here, virtually overnight. And then as soon as the recovery, kind of the market, stock market, kind of bottomed and so on, we've recovered quite strongly, and we've hit $1.10 in the last couple of years. Kind of psychologically for Australians, that's a really, really hard number to deal with. They're happy with an 85-cent dollar, and they can plan and forecast based on that, and they kind of think that's fair value for the Aussie dollar. But at $1.10, all of a sudden exporters can't export. The Australians start thinking, wow, we're rich, we can go overseas and go to Hawaii on vacation and it seems cheap, or go to Europe or New York and actually spend money. Previously, when the Aussie was down at 50 cents, I mean, that was, you were scrimping to do kind of big trips like that. But now traveling overseas, the Australians kind of feel fairly rich. Now in terms of our import prices, some things have come down. TVs and electronics and Mac computers have come down in prices. Cars a little bit, but not all that much. But anyway, so psychologically at $1.10, that's a really hard number to sit at. And then we're currently sitting at about $1.02, just over parity. But this band between $1.10 and back at 85 cents, 85 cents is really important. Psychologically, Australians think we're really worth 80 cents, 85 cents, but the market's telling us we're worth $1.10. It's like, well, why is that? Now, alongside this, so that's the blue line, this is what the Aussie dollar has done. Alongside that, what I've done is I've put the difference in growth rate in M3 money supply. This is the one thing I've looked at. I've kissed quite a lot of frogs when it comes to looking at this. Back in the day, in my consulting days, I looked at a bunch of things in order to try and figure out what was driving the Aussie dollar. Interest rate differentials, all of those things, really didn't have all that much impact. The one thing that seemed to have, an impact was the difference in the money supply growth, and it's a little bit counterintuitive. Let me try and explain it. The red line here is the difference in money supply growth between the US and Australia. And if the line is going up, that means the money supply in Australia is growing faster than the US. Now, how does that work? What's actually happening is when Australia is viewed as a good place to invest, particularly in mining infrastructure projects, what happens is the money flows in from overseas to buy into and invest in those large infrastructure type projects. If there are businesses to be bought, the money kind of flows into to pick up those businesses, and in general the money supply grows in Australia. There's also the lending that happens locally, so the banks go out and lend to the big miners to build these large infrastructure projects, or the mining infrastructure type projects. They're also kind of behind a lot of the acquisitions or the private equity or whatever it might be. So in general, when Australia is viewed as a good investment, the money flows in, the banks create money, and the money supply grows in Australia. M3, the broadest money supply, so it's not just cash and term deposits, it's everything. It's the biggest kind of measure of money supply. And then you compare that with the US, and if our money supply is growing faster than US, then we're viewed as a good place to invest, and the Aussie dollar goes up. So during this period here, when I was talking about the dot-com boom in the US, what was happening was the money supply was growing faster in the US because the US was viewed as a better place to invest. Money was flowing into the US and businesses were being funded in the US, and therefore the money supply grew in the US faster than it was in Australia. As soon as the tech boom was over and the commodity boom started, we had the reverse. The money flowed into Australia, and we had net lending in Australia that went out to build these kind of big projects and all the ancillary kind of things that go along with that kind of GDP type boom, and the money supply grows faster in Australia. What's neat about this relationship is there's a lead and a lag. So luckily the money supply leads what the Aussie dollar is doing, so we can forecast. So here you go. You can see the forecast where we had the decline in the money supply growth, Australia versus the US. And the lead that we had coming into here was a couple of years with this decline before the Aussie dollar started to come off. This kind of decline was kind of more closer in terms of where the decline was happening, but the money supply was growing quite nicely faster while the Aussie dollar was still settling down here in the 50s for a year or so before it started to take off and go the other way. Now, obviously in the intervening time we had the global financial crisis where the Aussie dollar got hit and so on. And everybody kind of forgets that the problems, the subprime problems within the US, and everybody's first reaction, well, the US dollar will go down because there's a problem that there'll be a capital flight from the US. And in fact, that's not what happened. The money flowed into the US in order to repair balance sheets. So, the Aussie dollar got hit very badly, although in terms of what we were doing, the Australian economy was a lot stronger than what was happening. And we effectively, almost sailed through the global financial crisis with very little, kind of repercussions compared to everybody else. It wasn't nothing, but it was compared to everybody else. We did a lot better. Now, what you can do with the money supply is factor out the effect of TARP and quantitative easing and all of those programs that went on. With the quantitative easing and TARP programs and so on included in the money supply in the US, you can see this green line kind of go down here, and that actually shows what in fact happened. That was closer to what actually happened to the Aussie dollar versus the US dollar. The red line is if you take out the impact of QE and TARP and so on, and this is what should have happened to the Aussie dollar. So that's kind of an interesting kind of side argument here, and you can see the magnitude of the difference is absolutely huge in terms of the money supply growth, and that was the impact of what they did in the US to grow the money supply faster in the US than it was happening in Australia. So we had this kind of decline down here. Now subsequently the green and the red lines have come a lot closer together, so the impact of those TARP programs kind of being wound back and so on. Still got QE kind of going on in the US and so on, but the net impact of those is relatively small. But what's happened in the meantime, in the last couple of years, is the Aussie dollar has been stuck above a dollar parity with the US, and yet the fundamentals in terms of the money supply growth had really taken a hit. So a couple of years ago, this hit here was effectively, there was a sudden realization that the mining boom was over, and a lot of the, forward planning for big mining projects kind of stopped, and so that kind of investment in the mining sector started to decline. And we're starting to see the decline in terms of not necessarily volumes, but certainly prices have come off in the last year and a half in the mining sector. And so what's gone on here is this has kind of come down quite considerably. But in previous years we had a lot tighter match between these things. Obviously we've got the shenanigans going on in the US with the Fed marking the difference between what was happening in the financial crisis '08. But in the last 3 years, what's gone on? Why have these diverged? And my argument would be this kind of safety haven argument that Australia is becoming the Switzerland, is that you can park your money in Australia relatively safely. Okay, the interest rates aren't great, but at least they're better than elsewhere. The property prices are still high, but at least they've not crashed. The Aussie dollar has, been supported at $1 versus the US dollar, and so, in terms of currency stability and currency strength that we had in the last 4 years, that's all been a good story. So that would be my argument for why there's a differential between these two. The fundamentals are saying that the Australian economy ought to be weakening and the Aussie dollar ought to be weakening. However, we've got this kind of flight to safety argument which is supporting the Aussie dollar at the moment. So now let's look in terms of some charts and commitment of traders. This is a very long-term chart of the Aussie dollar on a monthly basis. Now, this is the continuous contract futures of the Aussie dollar. Now, with continuous contracts, the way they concatenate them together, it means that when you look back at price history, you get some divergences. So that the bottom of the Aussie dollar that we had in 2000 was around 52 cents, something like that. On a continuous contract basis, it's 20 cents. Okay, just bear that in mind, that this is a continuous contract kind of view of the world, and so there is a difference there. But the difference in the commitment of traders over this time period, and what we've got down below here, is what the professionals are doing in terms of commitment of traders. And I flip it upside down. So if they're short, it's positive, if they're long, it's negative, and so on. The reason why I do it is that it follows what's actually happening. You have they're moving in the same direction when you look at the chart versus the commitment of traders. Pre-2000, you can see the commitment of traders really moved around a great deal. We had big swings up and down in terms of what the professionals were doing, net long, net short. Come 2000, all of a sudden the Aussie dollar kind of goes in an upward tear, and they've been very bullish in terms of their positioning. It's above the line. Say that in terms of the way this is pointed, and so it's kind of been consistently like that. The gold chart looks very like this, the silver chart looks very like this. In 2000 there was kind of a fundamental shift in the way the Aussie dollar was being perceived. However, in the last few months we've got these bearish divergence patterns kind of start to come in. The Aussie dollar is finding it difficult to get through this kind of $5 on the futures, $10 on the cash. We've got these bearish divergences kind of come in here. And if I go to the weekly chart, you can see how these peaks are getting smaller and smaller as we're kind of coming through this time period. So the last peak that we had a few weeks ago was kind of lowest peak that we've had in a while. And then, the little bounce that we've had over the last week or two has been extremely weak. Now, whenever previously we've come negative, on this chart, we bounced quite nicely from it. So let's see, I'm expecting this to kind of turn negative over the next several months and see where it goes. We could have a little bit of a sell-off in the Aussie dollar. I don't think this is all over Red Rover for the Aussie dollar. I think it's going to kind of settle down, because I think the combination of that kind of safe haven view of the world will mean that there will be some fundamental support for the Aussie dollar. I don't think it'll go to certainly not to the 50s, and I don't think it'll reach the 80s, but it could certainly kind of come off. But as soon as we get a little dip like this, we're starting to see that coming off. So it's potentially that the professionals are reversing and going the other way, and so we could actually see us dipping through the parity level. In terms of the daily, weekly, and monthly charts, now I always like the weekly chart to help in terms of trend. It's kind of the middle time frame, and I like to see exhaustion patterns and end of trend patterns on this time frame. You can see, coming into this high up at 105 on the futures market, we had our exhaustion buying and a bearish divergence at pullback to end of trend. Once we see that, before it wasn't quite a left shoulder, it's more on the end of trend signal. We have to wait for the second cyclical turn. Every time we've come back up into this 103, 105 type level, we've had Rambo patterns here. And in the last couple of weeks, we had this blue professional down bar, and I'm always interested in the professional bars because, you know, if we can't get back up through the highs of this on this dip, that means the professionals were not buying the dip, they were selling it down, getting on board this move. So we have a little complex correction or small kind of bear flag, and then all of a sudden, bang, we drop through this, and the critical level is this previous support at $1, at parity with the US dollar. We bounced off it last time. We've always kind of bounced off it kind of in the last several years. So as if we crack through this on a weekly chart, we'll be into a downtrend on the weekly chart, and we'll have to go pull back to end of trend. So I could see us have a little bit of weakness there. Now, in terms of the daily chart, what happened, I kind of referenced this a few days ago. This was kind of that week where we were selling this thing down quite quickly. And then the last few days we had amateur up bars testing back up into this 103.5 level week, and we kind of came back in here. We're sitting again at support level on the daily chart. So if we kind of head through a support level on the daily chart into a downtrend, that kind of momentum will most likely take us through support here on the weekly chart at parity, and then we could be into a downtrend. Now, these things never happen in terms of straight moves, you know, there's always kind of ups and downs, but the thing to be judging is when we're going through turning periods where we have the most volatility, what are we actually going to do? And my guess is that for me the higher probability, you know, outcome is that we drop through 102 on the daily chart. We head towards parity. We might stick around parity for a while because it's psychologically an important level, but then later in the year we could easily break through, and particularly if we have kind of global economic weakness around the world, the Aussie dollar will not do well. And then just to say on the monthly chart, I always like kind of the monthly chart. It gets a little confusing because, you know, better momentum with the volume of contracts traded is quite unusual here with the patterns it's making, but we haven't been able to get through here. This is the continuous contract to the futures. If you happen to look at this using the cash, so that's Aussie dollar versus US dollar on the cash market, it's actually a pullback to end of trend here. And you can see this is the difference I was talking about with going down to 20 cents on the continuous contract on the monthly chart. It's 50 cents down here on the cash market. So just that's the way continuous contracts, it's a feature of the way continuous contracts are built. So monthly chart, we got pullback to end of trend. We've got these two important levels over the next several weeks and months, 102 and parity with the US dollar. So let's see where this goes.